Hello there everyone, interesting video today, particularly if you are a property developer, and a recent court case which denied input VAT recovery. So let me talk you through the situation. We have an individual, Mr. X, and he owned a commercial property. And what he did, he basically transferred it, he sold it to a limited company of which he was also a director. So we moved this across here. Now, there were tenants in there, so we could have got the transfer of going concern rules applied. That's where you don't have to add VAT to the sales price. But it basically, they kind of messed that up. So the bottom line is that output VAT had to be charged on the sale of that commercial building from him as a sole trader to his limited company. So the limited company paid him X 100,000 plus VAT to acquire this property, and then later on the company claimed that VAT back on its VAT return as input VAT. What was the company doing? Well, the company basically developed this commercial property, and it converted these commercial property into several flats and let them out. And HMRC opened up an inquiry and they said, hang on a minute, you can't have the VAT back of 200 grand that you've claimed here, that you paid to Mr. X as an individual, because what are you doing? You're making exempt supplies of rent. If you rent properties that are dwellings, then you don't charge VAT. You can never charge VAT, and that is an exempt supply. Therefore, all the associated costs around it, i.e. of buying the thing in the first place, you can't claim the VAT back because you're not making a taxable supply. So HMRC denied that 200 grand of input VAT. So this guy basically charges 200 grand, the company pays the 200 grand, he's got to pay it over to HMRC, but on the flip side, denied the 200 grand recovery. Right, so then it went to the tribunal and they said, look, it's all about intention. With VAT, a lot of the law is about intention. What did you intend to do? And this guy said, look, it was always my intention to sell these. I was never really wanting to let them out. I was always wanted to sell them. Because of course, if you sold these units, converted from commercial to resi, and then sold it, that, from a VAT point of view, is called a zero-rated sale. Crucially, again, no VAT is added to the sales price, but it's different from exempt because it means you can then claim the input VAT back. So had this guy have just sold the properties post-conversion, he would have got that 200 grand input VAT back from HMRC. And he said, no, that was my intention to sell it, but based on the market and everything else, I had to let them. HMRC said, look, let's have a look at the evidence here. So when the company applied to be VAT registered in the first place, after it bought the building, there was no mention. There was no mention at all of any sale. There was no mention that this was intentions whatsoever. So it all pointed to the fact that these units the intention was to let them out. So he also had a counter argument in this guy. He said, look, surely that HMRC is being unfairly enriched, and that is jargon in the VAT world, unfair enrichment. Often you hear it going the other way. HMRC will accuse the taxpayers of being unfairly enriched, unjustly enriched. And he said, you can see why he would put up this defence. He said, oh, hang on a minute. So basically, when you've got two taxpayers and one's charging VAT and one's claiming VAT, the two net each other out. So, but in this case, 200 grand was handed over to HMRC, but HMRC didn't then repay it to the company that claimed it. So HMRC are 200 grand up on the deal, for want of a better expression. Whereas had this thing worked from this guy's point of view, it would have been even Stevens. So HMRC 200 grand better off. But that didn't wash either. They said, look, this is the rules. If you are buying this building to then convert and let out, you ain't getting your VAT back on the purchase. So, cautionary tale, if you're a property developer, what he could have done, which is perfectly legit and relatively straightforward, to make sure that he had got the 200 grand back, even if it was the intention to let them out, is this. Here's the limited company, convert the commercial property into resi, so it's got all these resi units. All you've got to do is sell that block to an associated company. Just set up another company, sell it across, and then you don't have to add the VAT on this sale because it's a zero rated sale of the first grant of a major interest in a dwelling, as we call it. But basically, no VAT is charged on that. An input VAT would have been allowed to be reclaimed because that is a zero rated, not an exempt sale. Even though it's to a connected company, then at that point, this company, which hasn't suffered any VAT, just lets them out as was the intention all along, with no VAT added to the rents. So had he have just literally set up a new company, transferred the finished block post-conversion to his other second company, he would have got 200 grand check from HMRC. So, and that is perfectly acceptable to do. So, for goodness sake, be careful. I've said it time and time again. VAT is tricky at the best of times, even trickier when it's in the property world. Property VAT is the probably most complicated area in the VAT landscape. So for goodness sake, speak to someone before, not after. Not I'm trying to unravel stuff before you're embarking on any property transactions, resi, commercial, whatever it is. You need to speak to a tax person, particularly not only with regards to corporation tax or income tax, but VAT. It can turn around and bite you where it hurts, and I've seen it time and time again. So there you go, just an overview on a recent court case involving deduction of input VAT, which was denied by HMRC. If you like this video, please do subscribe. And as always, I'll see you soon.